With me is Bregje Roosenboom, Client Portfolio Manager with the Diversified Fixed Income Strategies, and we are going to talk global bond opportunities. Bregje, give us a quick recap. What is this strategy all about?
It's a total return strategy, a global total return strategy. So let's say high octane. It's a top-down driven strategy that invests in interest rates or takes advantage of positions in interest rates, currencies, and credit risk.
Okay, good. A lot of stuff is happening now in the world. There's a lot of sell-off, interest rates are declining, investors are slightly nervous. What's the outlook?
Looking at the recent sell-off, we think that the market has overreacted to what happened. It's a little bit too pessimistic about economic growth because we are still quite positive about the US. If you look at markets, they're basically afraid of a couple of things that are happening. One is economic growth in general. Second is they are afraid that monetary stimulus will not be enough to spur growth or to spur strong growth at least. A third thing is economic growth in China is really also what markets are worried about. EMD in general, as well as the growth in Euroland, which is also negatively surprising us. And the last thing that people are afraid of, what markets are afraid of, is the inflation in Euroland, which is still on the decline.
But what I feel is that you are not at all gloomy about the outlook. So how do you carry that through in your positioning?
Yeah, so we think that the market is, as I said, too pessimistic. We think economic growth in the US can accelerate from this point onwards. Not a big plus, but a small plus is possible. So we think that interest rates would go up in the US in the coming quarters. Also, if you look at markets, then what is priced in currently in terms of a Fed hike, we think that the first Fed hike will come sooner than what markets are pricing in. So that's why we can already take advantage of that view. Euroland, on the other hand, does remain problematic. There's high unemployment, there's high public debt, and there's low inflation. So that really there is our worry as well.
To wrap things up, give me a couple of main reasons why investors should invest in this strategy right now.
Yeah. Although we are a little bit cautious at the moment, because although volatility is low, volatility doesn't always say everything. It could spike up quite quickly. We think that a strategy like this that takes advantage of opportunities in the market. So, for example, now we lowered our duration in the US and the UK in anticipation of the rates going up. We bought a little bit of extra in high yield in EMD, just to take opportunities that are currently there after the recent sell-off. The search for yield theme, we think, is still very much alive. So for credit markets, as long as there's no recession and monetary stimulus is in place the way that it is, then we think credit markets will do well and we can take advantage of that. Another point to make is that we don't think that interest rates will be increasing very quickly in the coming quarters, but it is something to look out for. If we look at the last 12 months, performance of the strategy is 15.61. It's an amazing performance, of course, but that's not something we're going to expect for the next 12 months. So we think returns will be a little bit more modest, but not negative at all.
Well, we'll be keeping an eye on performance. Thank you, Bregje.
Thank you.